Shares of Celsius have actually had a really tough go of it over the past few weeks. The stock is down almost 30% from its highs. And I think what we're really seeing is a reversal from the really, really high valuation that Celsius had. It doesn't currently appear that there's anything fundamentally wrong with the company. And this is one of the things that I want to go through in this video is the difference between fundamental changes in what's going on in a business and perception changes in the market. Sometimes a stock can rise so quickly that it just simply gets out ahead of itself. And right now, Celsius is in a phase where growth is slowing from days when it was growing at 100% per year to a more reasonable growth rate, 30, 40, maybe 50%. It's still a very, very high growth stock. But the question now that investors are thinking about is how quickly is the bottom line going to improve? What sort of multiple is it actually worth? So let's dig through all these numbers today and kind of put some context around what's going on with Celsius. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's first look back a little bit at what has happened to the stock. This is a look at Celsius on Google Finance. You can see down about 5% as I'm recording on Tuesday. Over the past week, shares are down nearly 10%. And you can see the past month been a little bit volatile, but shares peaked pretty close to $100 per share, $96 per share. These are the closing prices. And you can see that the 52-week range is just about $100 per share. So at 71, we're down almost 30% from that high. But let's pull back a little bit with Celsius because I think it is important to put some context behind these moves. One, we have seen moves like this before, even just a few months ago. In March, there was a huge bounce in shares, and then things came back down to that $68, $70 range. Then earnings were reported. They were pretty good. The stock goes back up again. And the stock has come down, at least in the last couple of weeks, in part because some analysts were doing their channel checks and said, hey, Celsius is losing a little bit of market share in the energy drink market. Maybe it isn't growing quite as quickly as it used to. And what they're trying to do is figure out what does next quarter look like and how should they model growth in the future. And so that's where they're taking some hints and saying, maybe I need to adjust my numbers, my expectations for the next quarter. But let's pull back and look at what's actually going on with Celsius. This chart looks at Celsius's growth rate, and then the blue column is free cash flow. So you can see that this growth rate, really tremendous, compound annual growth rate, 108%. That's off a relatively low base in 2021, and these are trailing 12-month numbers. So don't expect that growth rate to be 100% for the next 5 years, let's say. But that you can see, based on these trailing numbers, that this is still a solid growth company. What you are starting to see in the most recent quarter is that growth is slowing just a little bit. One of the reasons for that slowdown in growth is because of inventory. What Pepsi said last quarter is basically they're going to reduce the amount of inventory that they're holding from Celsius. So what happens is Celsius has co-packers who actually produce the product for them. Celsius doesn't actually make anything themselves. Those co-packers send product to Pepsi. Pepsi then sends product to the end retailer. They're the distributor in this situation. So each piece of that value chain has a little bit of inventory. When you're growing like crazy and when you start a new relationship like Celsius did with Pepsi, you're building out that inventory. So Pepsi is going from zero inventory to the amount of inventory that they need to fill their channels. So this can create a huge surge in demand. That's part of the reason that we've had 100% growth over the last couple of years. But that doesn't mean that that's exactly what the sell-through or the number of end customers who are actually buying Celsius products lines up with how much Pepsi is buying. They're trying to line those things up, but there is this early surge in demand to fill the channel is what you would call it. And then eventually they're going to have to adjust their inventory to just keep in line with what the sell-through is to end market customers. And this is the balance that's going on. So Pepsi built up their inventory, started selling through to retailers and to customers. Now they're saying, okay, we understand this a little bit better. We're going to reduce that inventory level. We're not going to keep quite as much on hand. That's going to look like sales are slowing for Celsius, even if end customer demand is growing at a faster rate. We saw that last quarter. Management said, I believe it was revenue was about 30%, but sell-through was up about 70%. So there's going to be a mismatch between those two. In the past, it was a mismatch in the opposite direction. Demand from Pepsi was greater than growth in end customer demand. Now we're going to see that go the other direction. But long term, all these things are going to level out. And that's really what we need to keep in mind as investors is what is the actual end user demand? And I don't think we have seen any indications that customers are not buying their product anymore. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The next thing to look at is valuation, and this is really what has changed for Celsius over the last few weeks. And I don't think that investors should read too much into this, just that valuation has gone from being really expensive to just very expensive. So let's look at the charts here. You can see that price to sales is what I have in the gray chart, and that's bounced all over the place, but it's still 12.4 times sales. So that's pretty high multiple from price to sales perspective. Price to earnings, 78.8. That is a really high price to earnings multiple, even for a company that's growing as quickly as Celsius is. And really the only thing that's changed over the last couple of weeks is we've gone from a price to earnings multiple of 105 to 78.8. So what is the correct multiple for Celsius? Well, that's what we don't know, and that's kind of what the market is searching for right now. Still a very, very high growth company, but investors are questioning what should we price in from a growth perspective? Should we price in 30% growth for the next couple of years? Should we price in 40% growth? Depending on what you do, and if you're building models to try to predict the valuation of this company, those changes in the growth rate can really impact how you're going to value the stock. The way that I like to look at Celsius is it's still a very high growth company, still a lot of runway for growth. It's basically not even scratched their international potential, still expanding a lot in the US to quick serve restaurants. I'm seeing it pop up more and more throughout my life. And this is a drink that's still only a year or two old here where I live. So I think there's still a lot of opportunity for growth, but don't be surprised that volatility and changes in the multiple that the market thinks that Celsius should be trading at is just a normal part of the stock over the next few quarters. What we want to see is that revenue continuing to grow and then margins increasing as well. So the company is actually increasing free cash flow and profitability. If those two things happen, the stock will continue to move higher, maybe not at the rate that we've seen over the last 5 years, which was just an astronomically strong rate. So I don't think there's anything broken about Celsius as a company. It's just the market adjusting the multiples that it's putting on the stock. That's why the stock is down so much for the last couple of weeks. But definitely not a reason to sell at this point because we don't have any news that would tell us that the thesis for the business is fundamentally broken. But what do you think about Celsius today? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.